Why HNIs and global businesses should shift to GIFT City. India's answer to Singapore and Dubai. Imagine this. Last year alone, over 5,100 Indian millionaires left India seeking tax havens abroad, followed by 4,300 more this year. HNIs and corporates are packing for Dubai, Singapore, or Monaco, all to escape heavy taxes and restrictive regulations. It's a wealth exodus driven by better tax regimes and global access. But what if I told you India has a bold answer to stop this fight? Enter GIFT City, Gujarat International Finance Tec-City, a shiny new financial hub in India designed to rival Singapore and Dubai on Indian soil. In this video, I'll explain why HNIs and global businesses should shift to GIFT City, how it offers a world-class tax-friendly ecosystem, and what makes it India's very own Singapore or Dubai. By the end, you'll see how GIFT City can keep your money global without leaving home. GIFT City stands for Gujarat International Finance Tec-City, located in Gujarat between Ahmedabad and Gandhinagar. Think of it as a city within a city, India's first international financial services center. It's built as a special economic zone plus an IFSC, meaning it's physically in India but legally treated as an offshore international finance zone. Onshoring offshore. GIFT City mission is literally bringing offshore finance onshore. Instead of Indian HNIs and companies managing investments via Singapore or Dubai, GIFT City provides those same services within India with comparable tax and regulatory perks. It's a place where you can do international deals in foreign currency, but right here at home. It provides a unified regulatory framework. GIFT City isn't under the maze of multiple regulators. It has the International Financial Services Centers Authority, a single unified regulator created by Parliament under the IFCA Act 2019. IFCA combines powers of RBI, SEBI, ADA into one, so banks, insurers, stock exchanges all can answer to one regulator. This single window regulation means faster approvals and simplified compliance instead of red tape. Liberalized currency rules are available in the GIFT City because transactions are done in foreign currency by law. The usual FEMA restrictions are relaxed and the money can flow in and out for bona fide reasons freely. In fact, foreign investors can repatriate funds freely with no FEMA roadblocks. It's as if GIFT City is a tiny foreign territory for finance, even though it's within India. So, what is the legal framework and the tax acts? India's government has baked special provisions into law to support the GIFT City. The Income Tax Act has Section 80LA giving IFSC units a long tax holidays. The Companies Act and other laws have tailored rules for IFSC units, like relaxed accounting norms, faster incorporation. The IFSCA issues its own regulations aligned with global standards for banking, capital markets, insurance, etc. So doing business in GIFT feels like doing business in London or Singapore with an Indian twist. GIFT City's infrastructure is backed by a unified regulator and special laws creates a business-friendly bubble within India. Low tax, high flexibility and global accessibility. Now, let's talk about those tax benefits. The real reason everyone's excited. What makes GIFT City so attractive? In a word, taxes or lack thereof. The government has rolled out the red carpet tax incentives for anyone operating in GIFT IFSC. Here are the big ones. No capital gains tax on specified securities. If your fund or company in GIFT City buys and sells securities on IFSC exchanges, there is 0% capital gains tax on those transactions. Foreign investors trading in GIFT literally pay zero tax on their investment gains in India, a treatment similar to Dubai or Singapore's tax neutral status. This is huge for HNIs investing globally or in Indian markets via GIFT. No dividend distribution tax. Companies operating in GIFT City don't pay DDT on dividends. In India, DDT was a tax on companies when they paid out dividends. While India abolished DDT for others in 2020, GIFT City was always DDT free. This means if your GIFT City fund or subsidiary distributes profits, there is no extra dividend tax, making profit extraction efficient. Interest income can be earned tax-free in GIFT City in several ways. For example, if a gift-based banking unit or finance company pays interest to a non-resident lender, there is no tax or withholding on that interest in India. Also, IFSC entities issuing bonds enjoy tax exemptions on the interest paid to investors. Often, interest is either fully exempt or taxed at a very low rate as per the special provisions. So, an HNI investing in IFSC bonds or depositing in an IFSC bank can earn interest without Indian tax cutting into returns. There is zero GST on offshore services. GIFT City units are treated as exports for many services. If your company in GIFT provides services to clients outside India, it can charge 0% GST. For instance, an investment advisory in GIFT serving a client in New York will not add GST, making your service effectively cheaper by 18% compared to an onshore Indian service. Also, any goods imported into the SEZ for authorized operations come duty-free. Overall, indirect taxes are minimal. Now, the biggest tax benefit, a 10-year tax holiday. This is the biggest one. 100% income tax exemption for 10 years out of the first 15 years of operation. Under Section 80LA of the Income Tax Act, a company or fund in GIFT IFSC pays 0% tax on its business income for 10 consecutive years of its choice within the first 15 years. For example, if an asset management company starts in 2025, it can pick any 10 years up to 2040 to claim zero tax on profits. Even after the holiday, the taxes are low, and there is concessional 9% MAT during the holiday versus 15% normally. This holiday is a massive draw, effectively a decade of tax-free compounding for your business. And there's more. No securities transaction tax, no commodities transaction tax, and no stamp duty on transactions done on the IFSC exchanges. Even salaries of employees in IFSC get a 50% income tax break for a few years to attract the top talent. It's a total package of tax incentives deliberately crafted to mirror the tax neutrality of global financial hubs. In short, GIFT City offers a tax environment so attractive it genuinely rivals traditional havens. For HNIs, family offices, and companies, this means higher post-tax returns, lower cost of doing business, and globally competitive operations. These benefits aren't just theoretical, they are changing behavior right now. Let's look at two quick stories. Case 1. A UAE-based HNI using GIFT for investments. Meet Raj, an affluent Indian businessman living in Dubai. Raj wants to invest in Indian startups and global markets but avoid India's high taxes. Instead of routing money to an offshore fund in Mauritius or Singapore, Raj sets up an alternative investment fund AIF in GIFT City. AIFs are like hedge or VC funds. His GIFT City AIF collects money in US dollars in the IFSC and invests in, say, Indian equities and US stocks. What's the result? Raj enjoys zero capital gain tax on the fund's India investments and no tax on repatriation of profits back to his UAE accounts. He faces no dividend taxes on distributors from the AIF either. Essentially, by using GIFT City, Raj gets Singapore or Dubai-like tax treatment while investing in India, all within a framework that's under the Indian regulators. It's the best of both worlds: global investment freedom and tax efficiency with the comfort of an Indian oversight. The IFSC's new Families Investment Fund framework even allows a single family fund in GIFT. So wealthy families like Raj can set up a self-managed fund pooling only their own wealth, a structure that earlier forced them overseas. This framework is enabling Indian millionaires to do wealth management at home. Case number 2. Fund managers moving from Singapore or Mauritius back to India. It's not just individuals. Big fund houses are coming home. In the last year, 8 of India's 10 largest asset management companies have either shifted or planning to shift many of their offshore funds from Singapore, Dubai, and Mauritius to GIFT City. Why? Access to Indian markets and tax breaks. For example, Mirai Asset, a global fund giant, moved $200 million fund from Hong Kong to GIFT City, citing a stable regulatory regime and proximity to Indian markets as driving factors. DHP Mutual Fund is moving its $450 million Mauritius fund to GIFT IFSC by this year. And Aditya Birla Sun Life AMC, a top Indian asset manager, is shifting operations from Dubai, Singapore to GIFT as well. One executive said it plainly: Operating a fund in Gift City is substantially more cost effective than in Singapore or Mauritius due to lower rents, lower cost of talent, and tax incentives. Plus, Gift City imposes no taxes on the transfer of funds from overseas and no capital gains on IFSC investments, meaning a fund can relocate assets into Gift without a tax event and then enjoy tax free gains going forward. Over 80 fund managers with $30 billion in commitments have set up in Gift IFSC in the past 3 years alone. This is a massive endorsement. The financial industry is voting with its feet. These case studies prove that Gift City isn't a theoretical promise, it's happening now. HNIs abroad are using it to invest back home efficiently, and India's own financial institutions are repatriating their offshore ventures to Gift. They are doing this because Gift City delivers a Dubai like tax haven experience without the drawbacks. So, how does the Gift City really compare with the established giants like Dubai, Singapore, or Hong Kong? Let's do a quick head to head on key parameters: tax rates, ease of doing business, and regulatory freedom. The table shows a comparison of the Gift City with the global financial hubs. As you can see, on pure taxes, Gift City is on par or better. No capital gains or dividend taxes, just like Dubai, Singapore, Hong Kong, and a full corporate tax holiday, which even Dubai and Hong Kong don't give. They have low taxes, but not usually 10-year complete exemptions. Singapore's 17% corporate tax can't compete with Gift's 0% for IFSC units in the short run. On regulatory freedom and ease, Gift City's advantage is its newness and government support. It's building a reputation for flexibility. Example, quicker approvals, sandbox environments for new fintech products, and a willingness to update rules. The IFSCA frequently consults industry and tweaks regulations to stay competitive. In contrast, while Singapore, Dubai, Hong Kong are very business friendly, they are also mature markets with heavier legacy compliance. And in Dubai's case, you may deal with multiple jurisdictions, the DIFSC free zone versus the mainland. On cost, operating in Gift City is far cheaper. Office rent in Gift's brand new towers is a fraction of Singapore's Marina Bay or Hong Kong Central. Skilled financial talent in India costs much less than in those cities. Yet you have a huge supply of English speaking professionals. This cost arbitrage is a big draw. Kotak Mahindra's bank team noted Gift is substantially more cost effective for running a fund versus Singapore, Mauritius, or Dubai. Dubai has no income tax, but living costs and rents are high. Singapore and Hong Kong are consistently among the world's most expensive cities. So, what's the bottom line? That Gift City offers comparable tax advantages, a supportive regulatory regime, and a dramatically low cost base. It's like getting Singapore's finance environment at a discount, and with India's growth story behind it. No wonder global businesses are taking note. So far, we've talked about investors and fund managers, but what about the chief financial officers of large global companies or Indian multinationals? Gift City open up strict avenues for them too. Global treasury management. CFOs can a global or regional treasury center in Gift City to manage the company's worldwide liquidity and funding. Instead of keeping cash in offshore entities or facing Indian capital controls, a Gift based treasury unit can borrow freely and lend in foreign currencies, pool group funds, and manage investments globally. The IFSC banking units offer international banking services without domestic restrictions. In fact, external borrowing norms don't apply to loans taken by IFSC units, meaning your Gift treasury can raise funds overseas more easily and cheaply than a regular Indian company could. Companies like Indian Oil have set up their finance arms in GIFT City for precisely this reason. With recent tweaks, IFSCA has also made it easier to pilot treasury operations. That is, you can start small with lenient initial conditions and ramp up. For CFOs, this means your global treasury can finally be in India in a dollar environment, fully compliant yet unconstrained. Captive insurance and reinsurance. Large corporates often create captive insurance subsidiaries to self insure their risks, which is common in places like Bermuda or Singapore. Now, you can do that in GIFT City. Captive insurers in GIFT IFSC get 100% tax exemption for 10 years, and their insurance services to other IFSC units are GST 0 rated. Plus, GIFT allows writing global insurance or reinsurance business in foreign currency under the IFSCA's regulations. This is a boon for any CFO thinking of a captive to cover up the group's global operations. You get a well-regulated framework with significant tax savings. Regulators are continuously working on expanding this. IRDAI has been laying groundwork to make GIFT a reinsurance hub. Fintech, fund headquarters, and more offices. If you are a fintech or a financial services firm, GIFT City is a sandbox to launch innovative products like digital banking, blockchain-based trading, etc. with an accommodative regulator. But even non-financial multinationals can benefit. You can establish an in-house finance company in GIFT for tasks like global leasing or factoring. For example, aircraft leasing companies are coming to GIFT attracted by zero tax on lease income and an extended tax holiday until 2030 for new lessors. An airline CFO could lease planes through a GIFT subsidiary to save on taxes that would be paid in Ireland or Dubai traditionally. Fintech startups get access to a growing ecosystem of 55 plus fintechs and friendly policies in the IFSC. There are relaxed regulations for outbound investments. The IFSC also serves as a base for Indian companies or funds to invest abroad without running into the usual roadblocks. Under RBI's liberalized framework, Indian residents can invest in GIFT City funds under the LRS, and then that fund can be deploy money globally. A clever route that several wealth managers are using for clients to bypass individual foreign investment limits while staying legal. For CFOs of Indian startups or funds, this means you can pool domestic and foreign capital in GIFT and use it to acquire overseas assets. Something notoriously hard under the normal FEMA rules. Global companies can use GIFT City to pool foreign earnings from different subsidiaries and redeploy them efficiently. Since GIFT units are treated as non-resident for many purposes, profits parked there aren't immediately taxed in India and can be invested or returned to various jurisdictions seamlessly. Many corporates are now considering moving their holding or IP companies to GIFT City from places like Mauritius to enjoy India's tax treaties plus IFSC benefits. In essence, for a CFO, GIFT City is not just about tax saving, it's about consolidating and simplifying global financial operations. Treasury, insurance, financing arms, investment vehicles all can reside in GIFT, leveraging India's talent and legal system while remaining globally competitive. And importantly, the government and regulators are actively smoothing the way. The RBI, SEBI, IRDI have all issued circulars clarifying that transactions through GIFT IFSC are kosher and often exempt from legacy restrictions. The framework is robust and only getting better. Some of you might be thinking, this sounds great, but is it sustainable? What if policies change? Rest assured, GIFT City has a strong backing at the highest level of policy, and it's here to stay. Laws and regulations in the GIFT City aren't based on executive whim, they're grounded in laws. The IFCA Act 2019 established the regulatory authority with a mandate to develop the IFSC. Section 80LA is a part of the Income Tax Act. Various sections like Section 104D, 4E, etc. explicitly grant tax exemptions for IFSC transactions. For example, no capital gains on IFSC exchange trades, no tax on interest or royalty for aircraft leasing under IFSC units. These were passed by the Parliament and even extended recently. The Budget 2025 extended key IFSC tax benefits to 2030 to attract more businesses. so the legal foundation is solid. The tax authority, CBDT, continuously issues notification to clarify and improve the IFSC regime. For instance, in 2025, the CBDT exempted certain payments to IFSC in units from withholding tax entirely, that is, no TDS. This means if your GIFT City unit is in its tax holiday, clients are paying you certain fees, interest, commissions, they don't have to deduct TDS, which simplifies operations. Such moves shows the government's commitment to ease of doing business for the GIFT. They have also clarified that relocating offshore fund to GIFT is tax neutral. There is no exit tax and that GAR won't randomly invalidate genuine IFSC transactions. The RBI supporting too. The RBI has been on board since day one. It allowed Indian banks to open IFSC banking units in GIFT and permitted them to do things like trade in foreign derivatives, finance external projects, and lend to Indian companies in foreign currency. RBI also relaxed norms so that money can move to and from the GIFT IFSC without treating it like domestic flow, effectively considering GIFT as offshore for forex purposes. They even concurred to allow NRIs and others to trade on GIFT exchanges. This clarity means you won't wake up to some RBI crackdown and the central bank is in the loop and facilitating GIFT's growth. While no major Supreme Court ruling was needed specifically for GIFT City, since the laws were clear, the judiciary has generally been supportive of special economic zones and such taxpayer-friendly schemes as long as they are per the law. GIFT City hasn't faced any legal challenge, a sign that's built on consensus. Politically, both the central and Gujarat state governments are all in on the GIFT City. It's a flagship project, often mentioned in economic surveys and vision document as the future of India's financial sector. This bipartisanship and long-term policy continuity indicate that GIFT City's advantages aren't going anywhere. If anything, they will improve. In summary, GIFT City's environment is not a loophole or a temporary experiment, it's a deliberate policy pivot. India wants to create a globally competitive financial center and is providing the regulatory clarity and legal certainty needed. You can confidently plan a 10 or 20-year strategy around GIFT City. Despite all these positives, some myths persist. Let's bust a few common myths about GIFT City and lay out the facts. Myth 1. Money gets stuck in India. If I bring funds to GIFT, I won't be able to take them out freely. This is completely false. Full repatriation of capital and profits is allowed from the GIFT City without restrictions. GIFT is treated as a foreign territory in forex terms, so you can pull out your money, principal and gains anytime just like you would do from Singapore. Many funds routinely repatriate dividends and redemptions from GIFT to investors abroad seamlessly. Myth number 2. Compliance and KYC are lax. Is GIFT some Wild West with loose compliances? Fact is a big no. GIFT City adheres to global compliance standards just like any other major financial hub. IFSC requires the same, if not stronger, checks as SEBI or RBI. The difference is not in standards, but in efficiency. Single regulator, unified IT systems, so compliance is robust and less of a headache. Global banks like HSBC, JP Morgan have units in GIFT precisely because the regulatory environment meets the international norms. Myth number 3, it's only for financial companies. If I'm an industrial company CFO, GIFT has nothing to do with me. Fact, it's completely wrong. As we discussed, non-financial companies can use GIFT City for treasury operations, captive finance, captive insurance, global shared services, etc. Many large corporates, from oil companies to tech giants, have already set up subsidiaries in GIFT to manage global finances or insurance. And GIFT is expanding into areas like aircraft leasing, bullion trading, even hosting foreign universities. It's an ecosystem, not just banks and funds. Myth number 4. The setup is too complicated or slow. It will take ages to start in GIFT, and the Indian bureaucracy will kill it. The fact, not at all. In reality, setting up in GIFT is faster and simpler than in most Indian jurisdictions. Thanks to IFSC's one-stop clearance, you can form a company, get a license and be operational in a matter of weeks. Fast-track approvals and digitized processes are the norms. All regulators' approvals are on a unified online portal. We have helped clients get an AIF fund license in GIFT in as quick as 4 to 6 weeks. In fact, in part 2 of this series, I'll walk you through how to set up an AIF in GIFT City in 30 days. It's very doable with the right guidance. Myth number 5. GIFT City is unproven. Is there really an ecosystem there, or is it a ghost town? The fact is that the GIFT City has grown into a vibrant financial hub. As of 2024, it hosts 31 banks, 80 plus capital market firms, 37 insurance entities, 55 plus fintechs, and 140 AIFs. Global giants and Indian majors are there. The city's infrastructure is world class, tall office towers, data centers, even an international bullion exchange. It's ranked 52nd in the Global Financial Centers Index, climbing steadily. But it's a very much real and scaling fast and not a ghost town at all. If you visit, you'll see traders, analysts, bankers bustling about just like in Singapore's financial district. By dispelling these myths, we see GIFT City for what it truly is, a credible, cutting-edge international finance zone that's already delivering value. GIFT City is no longer just a vision, it's India's bold execution to bring back wealth, talent, and business that used to flee abroad. For HNIs, it's an opportunity to keep your investments global but anchored in Indian jurisdiction. And maybe sleep easier knowing your money is a 2-hour flight away, not halfway across the world. For global businesses and CFOs, it's a chance to centralize operations in a low tax, high efficiency zone without compromising on governance or stability. Imagine benefiting from Singapore-like tax savings, Dubai-like financial freedom, and Mumbai-like proximity to India's markets. All together, that's GIFT City for you, a fusion of the best of all the worlds. It's India's answer to Singapore and Dubai, and it's answering loud and clear. So what's your next move? If you're an HNI thinking of setting up an offshore trust, or a fund manager weighing whether to domicile your next fund in Cayman, or a CFO planning your global treasury strategy, pause and give GIFT City a serious look. The rules are in your favor, and the window of opportunity is here now. Early movers are reaping benefits and shaping the ecosystem. Thank you for watching. If you found this valuable, please like and share, especially with anyone managing wealth or business that could benefit from GIFT City's advantages. Drop your questions in the comments and I'll be happy to answer as CA Pranav Goyal. Remember, opportunities like this don't knock every day. GIFT City is open and the gift is there for the taking. Ready to make this shift? Let's unwrap GIFT City's potential together. Thank you.